Hello everyone, and welcome back to Explain the Charts. Today is October 19th, 2025, and we're taking a comprehensive look at Ethereum, symbol ETHUSD. There is a fascinating tug-of-war happening in the market right now, with a lot of conflicting news and chart signals, so we're going to break it all down for you. First, let's talk about the current events and news that are shaping market sentiment. On the bullish side, we're seeing continued and significant institutional interest. Firms like Bitmine and BitDigital are making massive purchases, with Bitmine executing a buy-the-dip strategy and accumulating over 128,000 ETH recently. Grayscale has also committed another $150 million to ETH staking, showing strong confidence in the asset's future and its potential for regulated yield products. This institutional accumulation is a powerful long-term bullish signal, suggesting smart money sees value at these prices. Furthermore, on-chain data shows that whale wallets have been quietly accumulating since the crash around October 11th, adding about 80,000 ETH worth over $330 million. However, the news isn't all positive, and there are serious reasons for caution. Just a couple of days ago, the entire crypto market lost over $100 billion in a 3-hour flash crash, driven by high volatility and leveraged liquidations. This highlights the current instability and risk present in the market. We're also hearing about a record $10 billion validator exit, with 2.4 million ETH awaiting withdrawal. While some analysts believe this is just validator rotation and not panic selling, it still introduces a potential overhang of supply that could hit the market. Another major warning sign is a bearish MACD crossover on the daily chart, a technical signal that has historically preceded major drops in Ethereum's price. So we have a classic battle. Institutions and whales are buying, but short-term traders are spooked by recent volatility, high leverage, and bearish technical warnings. Now, let's see how this narrative plays out on the charts, starting with the big picture on the daily time frame. Looking at this daily chart, we can see the massive volatility we've experienced over the past few months. We had a strong run up to the $4,800 level in late August, followed by a sharp correction. The most significant recent event is clearly the flash crash on October 10th, where the price plummeted from around $4,370 down to a low near $3,500. That low around the $3,500 to $3,600 area has now established itself as a critical support level. A definitive break below this level would be extremely bearish and could signal a much deeper correction. Following that crash, we've seen a strong rebound, which aligns perfectly with the reports of whale accumulation driving an uneven recovery. The price has fought its way back above $3,800, which now acts as a more immediate support zone. On the upside, the area from which we crashed, around $4,300 to $4,400, is now our primary resistance zone to watch. Now, let's zoom in on the price action since the beginning of October to get a better look at this recovery. This recent price action is forming a pattern that many bullish traders are watching very closely, a potential cup and handle. You can see the price dropped to form the bottom of the cup around $3,500 on October 10th and has since been forming a rounded recovery. According to this pattern's theory, the price could continue to climb towards the rim of the cup, which is back near that major resistance level of $4,300 to $4,400. If it reaches that level, we would expect to see a minor pullback or consolidation period, forming the handle of the pattern. Analysts suggest this handle could pull back to the $4,070 or even $3,950 level without invalidating the bullish structure. A close below $3,950 would be a major warning sign that this pattern is failing. However, if the handle forms and the price then breaks out decisively above the $4,400 rim, it could trigger the next major leg up. Short-term targets in that bullish breakout scenario would be around $4,550 and then $4,750. Let's switch over to the 1-hour chart to get a feel for the more immediate short-term trend. Over the past 48 hours, the price has been quite choppy, trading mostly sideways after a bounce from the $3.830s yesterday. We can see the price is currently struggling to gain momentum, reflecting the broader market uncertainty we discussed from the news. There's a clear short-term resistance level forming around the $3,930 to $3,950 area. Notice that this level coincides with the potential invalidation point for the cup and handle pattern we just looked at, making it a very important pivot point. On the downside, immediate support on this timeframe sits around the $3,820 mark. If we lose that level, the next stop would likely be a retest of the psychological $3,800 support. This tight range between roughly $3,820 and $3,950 shows a state of indecision in the market. Traders are waiting for a clear signal before committing to a larger move. Now, let's drill down even further to the 15-minute chart to see the intraday price action. As you can see, the last several hours have been characterized by very tight consolidation. The price is oscillating in a narrow band, with volume tapering off significantly. This low-volume sideways movement often precedes a period of high volatility. It's like the market is coiling up for its next significant move. For day traders, this can be a tricky environment. It's often wiser to wait for a confirmed breakout above the range resistance or a breakdown below the range support before entering a new position. Attempting to trade within such a tight chop can easily lead to getting stopped out. The key takeaway here is patience. Wait for the market to show its hand. Okay, let's pull back to the daily chart to recap and put everything together. The narrative is clear. Long-term institutional confidence is battling short-term fear and volatility. Let's summarize the critical price levels we've identified. Our most critical long-term support is the crash low around $3,500. Our immediate support area is between $3,800 and $3,830. The key pivot level to watch is $3,950. Holding above it keeps the bullish cup and handle pattern in play, while breaking below it would be a sign of weakness. Our major overhead resistance and the target for the cup formation is the $4,300 to $4,400 zone. Beyond that, the next significant resistance lies near $4,750. So, what are the likely scenarios? The bullish scenario, which I would place at about a 60% probability, involves the price continuing to hold above the $3,800 support. We would look for a push above $3,950, a potential consolidation to form a handle, and then an eventual breakout above $4,400. This scenario is supported by the strong underlying institutional demand and would be reinforced by any positive macroeconomic news or a recovery in broader market sentiment. The bearish scenario, which I'd give a 40% chance, would see the price fail to hold the $3,800 support. A break below this level would likely lead to a retest of the crucial $3,500 low. If that level breaks, it would invalidate the entire recovery structure, and we could see a rapid decline towards the $3,200 level, or even lower. This outcome would be more likely if we see actual selling from the validator withdrawal queue, or if geopolitical tensions continue to create market uncertainty. Things to watch for in the coming days are a significant increase in volume, which will signal conviction behind the next move, and continued monitoring of on-chain data for whale activity. Thank you for joining me for this analysis on Explain the Charts. Please remember, this content is for informational purposes only and is not financial advice. The cryptocurrency market is highly volatile, and you should always do your own research and consult with a professional before making any investment decisions. If you found this video helpful, please hit the like button, subscribe to the channel, and we'll see you in the next one.